Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Bernard Bogle III, and I'm just going to call him Bernie. Anyway, Bernie and I have known each other actually since we were children. And he is a corporate lawyer and partner in the Silicon Valley Law Group. He's worked with that firm since 2000 and has a total of about 25 years of experience as an attorney. He works in the areas of corporations, mergers, acquisitions, and finance. So welcome, Bernie.
Thank you,
for
Michael.
joining me today. Today, Bernie and I are going to be talking about the choice of form of doing a business. And this is an important topic, especially when you're first starting a small business. And so I have to let you know, though, that, again, we're covering just a few highlights of an enormous area of tax law and the rules related to choosing the form of doing a business. And so this is a bare starting point, learning about some of the issues. And so we want you to get qualified tax and legal advice. This discussion will focus on California law. Bernie is a California lawyer. I'm a California CPA. And the rules are going to vary somewhat for other states. So, with that, we'll get started. Bernie, when you're starting a business, most people think of starting a corporation. Oh, I'm starting my business, got to get a corporation. Is that really usually the best choice?
Well, Michael, as you well know, it's not necessarily true. There's many legal entities in California, and each one of them is most appropriate for different situations. We have S corporations, C corporations, we have limited liability companies, we have general partnerships, limited partnerships, sole proprietors, and limited liability partnerships. Not all of them are applicable for each situation, and we need to carefully evaluate what the goals and objectives and the tax ramifications are for the particular individual or individuals.
Mm-hmm. Okay. And I guess the one that we always want to point up as real estate. So
awful corporation entity, because as we may talk about later, corporations they're subject to a tax when assets are taken out, and this is a very bad place to hold real estate in corporations. So there's other entities that are much more appropriate.
Okay.
Sometimes also the legal entities can be used in combination and even get a better situation and get best of all worlds from each type of legal entity.
Right. So anyway, so if you have let's say a motel or a hotel, so the chances are that Hyatt doesn't own those hotels and its corporations. Those are being held in some other type of an entity, but the management may be actually, well, of course that's probably a franchise operation, and then, anyway, so you may have several different entities that are involved.
Absolutely.
With that type of an operation. Okay, so there is this area of confusion. Okay, most of us might think it's a corporation, but tax-wise, we have corporations that are taxed in different ways. We have C corporations and S corporations. So how do they work, and what are they best suited for?
Well, let's first step back. First of all, a corporation is a legal entity in which the owners, shareholders, have limited liability,
Mm-hmm.
which is wonderful, which is what we all seek for.
Mm-hmm.
However, there are ways of making elections and to either be taxed as an S corporation or a C corporation. The first thing, let's talk about the C corporation.
Okay.
The C corporation is a corporation in which the entity itself is taxed.
Mm-hmm.
And when the corporation makes distributions to its shareholders in the form of dividends or distributions, there is also a tax.
Yes.
Ergo, the concept of the double tax. We get taxed at a corporate level and we get taxed at the shareholder level, which is not exactly what we want all the time, particularly for smaller businesses. A C corporation is generally a corporation which is more applicable or more apropos for publicly traded companies. It has a lot of flexibility in terms of how we structure it for finance purposes. Mm-hmm. An S corporation, on the other hand, has some interesting tax ramifications. One, The S corporation has the benefit of the limited liability, like a C corporation, but the income is deemed to be earned by the shareholders pro rata based upon their stock ownership.
Mm-hmm.
That's very advantageous for a lot of people. Also, the earnings from those from S corporations are not subject to self-employment tax. One of the problems, though, with S corporations is that that has a limitation on the number of shareholders, has a limitation of the type of shareholders, and it has a limitation of the type of stock. Let's go through them. One, you can only have 100 shareholders. Not very good for a publicly traded company, right, Michael?
Right.
Two, only certain types of individuals can own the stock of an S corporation, generally U.S. residents. You can't have corporations and non-residents owning the stock of an S corporation. And three, the really challenging part of an S corporation is you can only have one class of stock.
Right.
This is very problematic because if you and I owned an S corporation and I wanted to have some special allocation to me, or I wanted to have preferences, I can't do that in an S corporation. You can in a C corporation, which is why it's very favorable in terms of venture capital deals or things like that.
Right, right, okay. So another type of entity, what are limited liability companies? A lot of people talk about those these days, and actually I would say almost as often as I hear, should I have a corporation, I hear, should I have an LLC? Why have they become popular?
Well, in 1994, California was probably the 42nd or 43rd state in the nation. That
A leader.
Yeah, we were way ahead on this one. But limited liability companies came onto the forefront, and everybody wanted to use them. They were very, very attractive. Cocktail Cock was on LLCs. And the limited liability company gives you a couple things. One, it gives you the corporate protection or the corporate characteristic of limited liability protection for the owners. In this case, instead of shareholders, we call them members. Mm-hmm. It gave you the ability to kind of structure centralized management with LLCs. The LLCs are treated as, unless you elect differently, are treated as partnerships. And partnerships are a very, very favorable arrangement for tax planning purposes. Mm-hmm. With an LLC, we can do pass-through of income to the members, much like the S corporation, but we can have different types of pass-throughs. We can have you get the income or the distributions first before me, or I can get a preferred return on my investment. I can get 8% of my money before you get anything. Mm-hmm. So there's a lot more flexibility with the LLCs. Very, very attractive. Everybody wanted them. There's a price to something like that, and in California our price is called the gross receipts tax. Mm-hmm. And the gross receipts, LLCs are taxed. They have an $800 minimum franchise tax like most California entities. But we charge in California, or our Sacramento legislators charge, a gross receipts tax which is based upon the gross receipts, very alien to us as owners. We normally view taxes based upon net income, right. Reduced by expenses. But in California, we did it by gross receipts, and it's done by categories. It starts off by you don't get taxed anything for the first $250,000 of income. After $250,000, it goes up to $900. Then it goes up to goes up in ratchets from to $900 to $250 to $6,000, between $1 million and $5 million of gross receipts, and then after $5 million of gross receipts, it's $11,790, as I recall. Yeah. So there's a problem there because, see, if you have a business which has a lot of gross receipts but very little net income, you can get taxed. In fact, you can get taxed when you're losing money in an LLC, which is very, very disturbing to owners. So that's a problem. In this situation, we use LLCs. We use them in combination sometimes to avoid the gross receipts tax. And it's